Welcome, welcome to our Friday live stream. There are no crying babies today, but we do have construction. So, that's fun. It's always something, right? What a market, though, huh? What a market. Who knew? Who knew? Who knew that the S&P and the NASDAQ would have a V-bottom bounce and end April up and completely reverse the 20% sell-off that it had at one point at the beginning of April, despite the fact that we have no tariff deals signed. Still a lot of rumors about what's happening between the U.S. and China. Obviously, we have some paths to a trade war de-escalation, and there's a lot of evidence out there that the U.S. government is out there negotiating trade deals. But do we actually have any in place yet? No. And the market has fully made up its April sell-off. Who'd have thought, right? I know a lot of you out there trading shorter term time frames picked up on the last few sessions that the indices were moving above some of the key moving averages and showing some of those breadth indicators. I think even as far back as late last week, there was reports out there about how the market rally was broadening. Of course, we've been in the middle of earnings, heavy earnings season, reporting seasons in this week. So we'll talk about some earnings here today. I've actually got some notes from a bunch of different companies that have reported so far on what they're seeing with the consumer and what they're seeing with the economy. I think interesting comments. I think it's still very, very early to see if there has been an impact from a lot of what's going on with the trade war. I don't think we've really fully seen a full impact on the consumer or the economy yet. Obviously, there's a lot that's subject to change as well. We're going to take some questions today. I'm a little bit under the weather, so bear with me on that. But yeah, our friends Nikki Dunn, she mentioned I got to give her a shout out because she mentioned that on the We Talk Money podcast a couple weeks back. She said, you know what, the pain trade could be higher. And actually the risk, she said this a couple weeks ago, the risk could be to the upside in stock markets here when sentiment gets so bearish. And that's exactly what we've seen. Now, could this be, another local top before we hit lower lows later in the year? Could be. I am noticing some interesting options flow today. We're seeing some pretty heavy hedging flow, it looks like, in Russell puts, some S&P and some NASDAQ puts, some XRT, which is a retail ETF. We're seeing some heavy put activity there as well today. So we'll see what happens. But, as it stands over the last couple of weeks, I think we've had 8 or 9 straight sessions of gains in the S&P 500. That's pretty wild. Most people would not have expected that 2 or 3 weeks ago, myself included, by the way. I'm still in a very, very defensive position in my portfolio. So I can show y'all that here in a minute. But yeah, the 100K portfolio is doing pretty well, actually. It's up about just a hair under 9%. It took a pretty hefty hit today, though. My second largest position, brutal, down 20% today, block. I thought, year to date now, look, before it gapped down, was already having a pretty brutal sell-off year to date. I thought, okay, the market's pricing in earnings being a miss already. It's pricing in an economic slowdown. All they have to do is basically come in line with expectations, or maybe even slightly worse than expectations, and it'll be all right. But nope, here we are, down almost 50% for the year now. My average cost on this, I thought, was pretty good. Around 56, 57 on the average cost. But, today, block is sitting at 47, 46. So I'm now showing about an 18% unrealized loss. I have not sold any shares. I'll tell you why. I did have to evaluate this morning. I looked at the numbers. I looked at the conference call, the transcript, thought through it a bit, and said, you know what? I think if I sell here, I can make a case for reducing the position or selling based on the fact that management's execution is lacking right now. However, on the other hand, this could be a classic sell the bottom if I were to sell, because the numbers aren't that bad. Okay, let's just talk real quick about what happened. And I actually posted a summary video of this in our Wealth Incubator community earlier this morning. But the short of it is this. Block entered 2025 with a pretty good momentum. They had gross profit acceleration in the fourth quarter of 2024. They were growing gross profit at around 14%. The bigger story here, though, is if you move further down the bottom line of the income statement, you look at adjusted operating profit or even something like cash flows. They did last year about $1.6 billion of adjusted operating profit, and that was versus less than $400 million of adjusted operating profit in 2023. So they basically more than quadrupled operating profit in 1 year. And a big part of that, of course, was that they continued to grow in 2024, but they also had really focused on efficiencies on the bottom line. So, they went from low single-digit operating margins to almost 20% operating margins in 2024. It was very, very impressive bottom line. Despite that, of course, the stock really didn't do much last year. Kind of chopped around throughout the year. It did end the year kind of on a high note because, again, they had accelerated growth in the fourth quarter. So fourth quarter looked pretty good. Then the stock sold off this year, and the market clearly kind of could tell that the macro environment was weakening, particularly for some of their lower income customers in the Cash App part of the business. So the stock had already sold off. And I thought, okay, we priced in already a Q1 earnings miss. No, apparently not. It was disappointing too, because what happened here is in the fourth quarter, after that great fourth quarter, they said, we expect strong gross profit growth again in 2025. We're expecting at least 15% gross profit growth. And by the way, we did $1.6 billion of adjusted operating income. We're going to do 30% growth again on top of that in 2025. We're going to put up $2.1 billion of operating profit, adjusted operating profit. So keep those numbers in mind, 15% gross profit growth, and for the year, $2.1 billion adjusted EBIT. Right off the bat, Q1 2025, and I know we're in a little bit of an uncertain, weakening economic environment, at least according to some companies. But right off the bat, they're below target. So gross profit's growing only 9%. Now, granted, that's still growing. It's not a bad number, 9% growth, not bad. And they took down their guidance for the year. So right off the bat, first quarter in, they're like, you know what, $2.1 billion of operating profit? Nope, just kidding. We are only going to do, can you see this? Here, let me actually, sorry, you can't see my screen. Duh. Let's see if we can pull this in. 1 second here, 1 second. Yeah, maybe this context would be helpful. I guess you weren't seeing any of my charts or anything. But the $2.1 billion of operating profit went immediately out the window. And there we go. And now they're saying 1.9, which again is not bad. That would be 18% growth over the 1.6 they did last year. So it's not all terrible. 18% growth in operating profit for most companies in a normal environment or even in a tough economic environment would be fine. But, the fact that they entered the year with a much stronger trajectory and then immediately after Q1, we're already saying, you know what, we got to take our guidance down, was a real kick in the you-know-what for investors. And so that's why the stock's down 20%. It's probably an overreaction. Again, if they could hit their revised targets for the year, an 18% operating growth is not bad. And now, by the way, the stock is also trading at its cheapest valuation ever. Let's just plug this in here in Koifin, which if you do fundamental analysis, I think is one of the better platforms out there these days. There's a link in the description too if you want a discount code on Koifin, by the way, if you're ever interested. So the price earnings multiple now today sitting at around 10.5 times the adjusted earnings figure, or the earnings figure that is out there today. I know some analysts have already downgraded earnings, so there may be some more downgrades to come, but let's call it roughly, somewhere between 10 and 12 times now the revised earnings target for the year. A 10 times earnings multiple is basically reserved for companies that are struggling to grow ever again. And again, I know that they took guidance down, but let's say they even hit 15% operating income growth for you. That's still pretty solid. By the way, they have a big share buyback authorization in place, so they're going to be buying back shares here at relatively cheap prices now, relatively cheap multiples. So they could retire 5 or 10% of the share count here pretty quickly. So that's a positive. I don't love the fact that Jack Dorsey, he's really not the best operating CEO. We've seen that with Twitter. We've seen that when he's the head of a public company, he's not always focused. His teams are not always focused. And so I think what would be a real positive here is if we saw him step down from the CEO role, step into a chief creative role, something like that, or some sort of chairman role. Let somebody else who's good at operating the business day to day, week to week, quarter to quarter operate this business, because there's not enough accountability here. And granted, they have been getting more efficient on the bottom line. They've been cutting some excess headcount. He's really been focusing on trying to get the organization to move faster on innovation here in recent months. But you can't do that after you've already like whiffed your quarter massively. You need to see that in real time as things are developing, right? And get ahead of that. And so that's I think the issue here. It's not the end of the world. I mean, the stock's trading for, less than 11 times earnings. They got a buyback in place. There's good businesses here. They're still going to grow, most likely. Actually going to grow at a pretty robust rate. They say they have levers to pull for the rest of the year. And so, I think they've called out some things like expanding their lending programs and Cash App. There are some investors out there who, by the way, are saying, really? You want to expand your lending operations in a really scary macro environment? Like, is that really what you want to do? You want to expand lending in this economy? Certainly I could see why some people might have issue with that. But these are very, very short-term loans backed by a lot of like direct deposits into the Cash App ecosystem, things like that. So it's not like they're 30-year loans, So I think they can manage through that. But I'm also kind of curious why they're still working on this Bitcoin proto mining business, like the mining rigs. They're creating like new Bitcoin mining rigs. I just don't get. I know that Bitcoin investing and trading is kind of part of the Cash App platform. I think there's a lot they can do on the crypto side in the crypto ecosystem. Expand to more tradable assets. Do what Robinhood is doing, right? Like open up new staking opportunities. Open up like there's lots of innovation happening. Stablecoin stuff. There's lots of things happening in the crypto ecosystem that would be a natural segue here, as opposed to selling hardware and creating new hardware, which is just a weird business to be in if you're in SMB payments and consumer payments. It's just kind of just a weird third business to be focused on. I mean, it feels like that should be a completely different company. Anyway, so that's just one of the things I think that proves like Jack Dorsey kind of lacks some focus sometimes. Maybe he's got too many ideas going on in his head and not enough focus on like what's in front of him. So yeah, I get why the stock's down 21% today, but I think it's a bit of an overreaction. It sucks. It's costing me about 2% of portfolio value today. So I'd be up about 10 plus percent on the year, or 10 plus percent since I funded the portfolio last October. Still handily outperforming the S&P, but yeah, now I'm only up 8 or 8.5%. So it is what it is. I'm not going to sell all my stock here. I wish the position size were a little smaller, but again, I think risk reward from here is still pretty interesting. So yeah, that was interesting. Now let's talk more earnings here. So I don't know if you can see this. Let's blow this up a little bit. Zoom in here. We'll go through some of these transcripts. So we had a big earnings week, obviously. Earnings were okay. I mean, Q1 earnings really are not reflecting much impact, if any impact at all, from the tariff wars, and they are reflecting a little bit of a consumer spending slowdown. But even then, for most companies, the numbers have been pretty good. And so when you look through the results, you got to remember, like Q1 really is not going to show us much as far as tariffs are concerned. So what we've been focused on is comments from companies on their earnings calls. And so I go through a lot of the transcripts here. You can see, for example, MasterCards. I like to look a couple different ways at this. I like to look at some of the companies like the banks and the credit card processors who have a very wide lens of what's going on with the consumer and business spending. And I focus in very closely on what they're saying, not only about what they saw in Q1 spending patterns, but also what they're seeing through April. Because now we're sitting here in May. It's crazy. We're already almost halfway through the year. What the heck? But so, I want to hear what they're saying about April trends, and a number of them gave us April trend color. And then also, I want to focus in then after I look at the big banks and credit card processors at other companies that could be sensitive to changes in consumer spending. So travel companies like Airbnb and Royal Caribbean and the airlines, and then I'll also look at things like restaurants and retailers. We haven't had a lot of retailers report yet, but we have had a few restaurant chains report. Also like to look in, of course, at big tech. Big tech has a lot of different businesses that touch, B2B and B2C. So good to hear what they're seeing. They also have, a lot of potential tariff impacts, particularly companies like Apple. Apple was interesting, right? They didn't say a lot about tariffs. They didn't seem like they wanted to talk about tariffs. Let's go through these here, though. We'll just start. I've sorted this just by alphabetical ticker. So Apple basically said As it stands today, we don't have a clue how things are going to play out. We currently expect Q2 could have about a $900 million impact from tariffs. That's not that big of a deal when you look at Apple's bottom line. But they're continuing to assume revenue growth in Q2. Again, they really didn't talk a lot about tariffs. So what they are doing is they're going to shift some of their production that's going into the U.S. will shift to India. And so rather than manufacturing, say, iPhones in China, they're going to try to manufacture as many iPhones as they can in India to go to the U.S. market. They'll still have a lot of manufacturing in China for other markets, like, shipping to Europe, shipping to other parts of Asia, shipping to China, etc. They're also going to have their country of origin for certain products be in Vietnam for iPad, Mac, Apple Watch, AirPods, etc. So that's how they're trying to manage around the tariffs. Whether or not they stay in place or not, they don't know. Funny also to see a lot of the big tech companies basically threw a bone to shareholders this quarter. They upped their buyback authorizations. So we saw that from Apple. We saw that from Google. I believe, did we see that from Amazon? I'll have to double check. But I know Google added an additional $70 billion of buyback authorizations. Apple added an additional $100 billion of share repurchase authorizations. And they also upped their dividend, right? So they're kind of throwing a bone here. But basically they said for the March quarter, we had limited impact from tariffs. We're able to optimize supply chain, assuming current rates of tariffs, $900 million impact to quarterly costs. That may not be what the full cost is on an ongoing basis, but that's what we're going to see for Q2. Keep in mind, Apple does, what was there? Let's just look real quick. Their Q last quarterly numbers here were, operating income was $30 billion for the quarter, so they do in excess of $100 billion. So less than $1 billion quarterly impact on tariffs isn't going to be the end of the world for Apple. But again, there's still a lot of unknowns there. So Airbnb, they said there has been a noticeable slowdown in the travel sector, by the way. We're seeing this is pretty consistent across a lot of the companies that reported. They said overall spending, like Visa, JP Morgan, Bank of America, MasterCard, they basically all said this. They said overall consumer spending patterns remain pretty stable. Consumer spend grew in the first quarter on a year-over-year basis, but we did see some areas of weakness. We saw some areas of weakness in the low-income consumer, and we saw some pullback in travel. And not only did we see some pullback in travel from international travelers to the U.S., but we also saw some domestic U.S. travel declines as well. So Airbnb is also seeing that. They said they do expect to grow in Q2, but they expect that growth to moderate from Q1's growth rate due to softer results in the U.S. market. And I can pull up some of these quotes from the transcripts if you'd like. Amazon basically said, we have not seen demand slow down yet. We have seen a little bit of buying ahead of tariffs, and we saw a couple of companies actually say the same thing. Basically, what they've seen is in certain categories where consumers know there's going to be potential prices increases because of tariffs on things like electronics or furniture or toys, there are some patterns, some evidence of some consumers buying more than they otherwise would have in Q1 because of that front loading. And so they have seen some buying ahead of tariffs and some inventory front loading by suppliers as well. So that we saw in some of the Q1 GDP forecasts as well, where any importers or manufacturers are trying to get as much product in the U.S. as they can before the tariff rates went into effect. So there's both a pre-buying impact on the consumer side and an inventory front loading on the supplier side. Interestingly, Amazon said we are not seeing price increases broadly yet across their supplier base in the retail business. They don't yet know where tariff numbers will settle out, but they are planning for a wide range of scenarios. That's another thing that we see consistently across companies this earnings season. Constant reference to wide range of scenarios / uncertainty. Uncertainty. That's the name. That's the word for the year. Bank of America, and they reported a couple weeks ago, but they said consumer spend, I believe, was up like 4%, 4.5%, something like that year over year from Q1 2025 versus Q1 2024. But they are predicting a slowdown in growth. But so far, consumer spending in aggregate looked healthy to them. Booking Holdings, which owns Kayak and Booking and a bunch of different travel booking properties, they basically said they're currently seeing stable global travel demand, global leisure demand in Q2, despite the macro concerns. So already in April, as we move into the April timeframe, they're saying we're still seeing stable travel demand, but there are some changes within certain travel lanes. So they're seeing less inbound travel into the U.S., and they're also seeing less lower-end consumers booking, but they are seeing still very good performance on the high end. So your 4-star, your 5-star hotels are still not really seeing any slowdown. Interesting to see that. Caterpillar. They expect Q2 sales in line with last year. They are going to have a margin hit from tariffs. Their costs are going up. But there's still a lot of uncertainty as to how much those costs are going to go up. Chipotle. Now, Chipotle is an interesting one. I think the restaurant sector, kind of similar to the travel sector, was an area where we did see some slowdown, some broader slowdown. Let's just look here. I've got the chart of Chipotle comparable quarter. These are the quarterly comparable sales for Chipotle. It's hard to see it, but this little tiny negative red bar here for Q1, negative 0.4%, same store sales or same unit sales versus the prior year. That's the first time we've seen that since COVID. So they went briefly negative during that, second quarter of 2020, the height of the COVID panic. And then, pretty much for the most part over the last, 5, 6, 7 years, though, comps have been positive until Q1 2025. So they did put up a negative comp quarter. I think the stock gapped down a little bit, didn't it, initially? I think it's recovered some. Let's take a look here. Yeah, over the last few sessions, it had a brief gap down on earnings, and then it's recovered. So, or wait, maybe this was the gap down on earnings. Yeah. Either way, it's had a pretty decent sized recovery since the earnings gap down. But Chipotle and a few of the other restaurant chains are seeing some weakness in comparable store sales. I think a part of that is consumers starting to be a little more tentative about spending, but I think it's also a lot of these restaurant chains like Chipotle just raise prices too much. It's clear from the McDonald's results. A similar thing happened to McDonald's. In fact, I've got McDonald's here in the spreadsheet. McDonald's said that broad-based consumer challenges, particularly among lower and middle-income groups, were evident. They remained cautious about consumer sentiment. But again, McDonald's had raised prices so much on some of their basic menu items over the last 2-3 years. I think that's a big part of the story about why they're seeing customers pull back, especially at the lower end. But, I think it is interesting that the lower end consumer definitely, if there is any cracks in the consumer, that's kind of where it is so far. Capital One, the big credit card provider, said the U.S. consumer remains a source of strength. And the driver of that, of course, is that unemployment remains low and stable. However, they did see easing off of travel and entertainment spending. So speaking of the jobs market, and this is key, this is where I think we're going to find out in the next, I would say, 2 months, whether or not this tariff war, the trade war, is going to have a real impact on the economy. I'm fairly certain that we're going to see a recession in the manufacturing economy if we're not already in one. But we have to remember the manufacturing part of the U.S. economy is only like 9 or 10% of the overall economy. Like we're a 90% non-manufacturing, mostly services-based economy in the U.S. these days. So the key question is, if this 10% of the economy is in a recession, how is it going to spill over to the other 90%? The way that would happen is a cascade of job losses. It's got to happen via, okay, all of a sudden your truckers or your trucking companies are out of jobs, out of business. Okay, your port workers, they start to see losses. Those consumers have to pull back because they lost their job. Then because of that, you start to see a little bit of weakness in other services-based businesses. They start to pull back. Business investment starts to pull back. And you get a slow snowball of job losses. But it's not a given that that's going to happen. It's not a total given, especially if these tariff policies get changed very quickly. And I think a lot of companies are kind of slow here to try to lay a bunch of people off because they know that one headline, one trade deal in a matter of weeks could change the whole picture. But we did get the official April non-farm payrolls, aka jobs data from the BLS today. And it looked like the economy still added jobs in April. So rather than losing jobs, it looked like the economy still added jobs according to the official data. And the unemployment rate was basically stable at 4.2%. And that's exactly what Capital One and some of these other companies have called out. It's like, look, we know that the sentiment data is terrible. Like the consumer sentiment data shows, like the Michigan consumer sentiment or the small business surveys, they all show that everybody's gloomy about the economy. But when it comes to the actual spending, it's like, look at what they're doing, not what they're saying, because their actual spending is not falling off yet, except for maybe in a very small cohort of consumers, particularly at the low end, and particularly in certain categories like travel. But everywhere else, it seems fine. So that's what Capital One is saying as well. U.S. consumer remains a source of strength because low unemployment rate overall. So until we see the manufacturing recession spill over into the rest of the economy, and that's not a given, but until that happens, I guess things are going to look okay. Etsy, Etsy says their tariff exposure appears low because they got a large amount of sellers on the platform. I think Wayfair said something similar. Amazon kind of alluded to that as well. Any platforms where you have a bunch of different sellers from a bunch of different geographic locations basically have kind of a diversification, because if one product gets removed, a similar product from another manufacturer in another country can kind of take that place. Not in every single case, obviously, but in a lot of cases. So a couple of the platforms like Etsy and Wayfair and Amazon said that. Etsy's kind of facing its own challenges right now because the housing market's weak, but they put up pretty good numbers overall, despite the fact that their merchandise volumes continue to go down. So they're not expecting Q2 to be worse than Q1, though. So that's interesting. Google basically said that in search, which is, okay, one, cyclically exposed to advertisers who might pull back because of the economy, and two, it could be at risk longer term due to AI threats. Despite all that, search had a great growth rate. I think it grew like revenue like 12% in the quarter on a year-over-year basis. And they said that they were seeing broad-based strength across verticals in search ads. Now, interestingly, they did say it's too early to comment on Q2 trends. They're not immune to the macro environment. So that did lead me to believe that maybe Google's seeing a little bit more weakness in ad spend than some of the other large companies out there. Maybe in April, they started to see some things roll over. We know there were companies like Temu and Shein. I showed this in my last video, that pulled back heavily. They went from spending a couple $1 million of spend on U.S. advertising platforms per day to basically zero in April. They pulled it all off, at least for now. So I think Google's probably seeing a little bit of that, and they're probably seeing in the travel category, which is a really key category for Google, they're probably seeing a little bit of pullback on ad spend there. Maybe that's why they didn't give us guidance for Q2. I think if things had been totally fine and there was no change in spending patterns, they probably would have said no change rather than it's too early to comment on Q2. That may be why we saw Google rally a little less than some of the others like Meta. But that's what Google said. They said the de minimis exemption change will cause some pain because of some of those Chinese good importers, that are basically like Temu style companies that are shipping small products and doing a lot of advertising for smaller dollar products. Those are going to face such high tariff rates that, they don't really have a way to survive unless they source from somewhere else. And so that's going to cause some of those advertisers to basically just get off the platform for now. Robinhood, man, they're firing on all cylinders. I was surprised. They said equities volumes were trading at 4-year highs. Option volumes were near all-time highs. They had strong deposit inflows in April. So like consumers are buying the dip, or retail investors are buying the dip, and they're buying it on Robinhood's platform. I think Robinhood's obviously gaining market share. The stock has, had a really nice rally there from 30 to almost 50. It's putting up great numbers. The stock isn't that overextended in terms of valuation at this point. I was hoping to buy this thing at like 20, 25. If we got a real deep market correction, we didn't quite get there. So we'll see what happens. But obviously Robinhood was firing on all cylinders. So they're really not seeing any weakness. And I thought capital markets volumes would be a little weaker for them in this quarter, but really they're gaining so much market share that it just was like, no problem for Robinhood. They're seeing volumes near all-time highs. JP Morgan, they were a little more cautious. They said, consumers and SMBs remain healthy in terms of their actual spending patterns, but there is a lot of uncertainty, and the sentiment data is really bad. And their economists are saying it's about a 50-50 shot of a full-blown recession this year is what their economists are predicting. Interesting. MasterCard, uncertain environment, weak sentiment, but no change to consumer spending patterns. That's a pattern we kept seeing. Meta had a very strong report. Meta said, we are giving a wider forecast guidance range, but they really didn't seem to forecast that there was any real weakness across ad spending. Just some small pockets where they said some e-commerce exporters had pulled back, but basically other advertisers had stepped in and redirected spend. And so generally they're seeing healthy trends in April in advertising for Meta. Meta's also crushing it with their Meta Ray-Ban glasses. They put up like over 50% profit margins in their core apps. They're losing a couple $1 billion a quarter still in the metaverse stuff and in the Ray-Ban division, but the core business is just so profitable and crushing it still. PayPal also said uncertainty has increased. We're planning for a wider range of outcomes, but again, consumer spending remains resilient. The labor market remains resilient. Good start to April so far. Maybe some pull forward. Maybe they're seeing some pull forward evidence in certain verticals where consumers are buying ahead of tariffs. Again, this is a very consistent theme. I think if we're going to see weakness in actual consumer spending, it's going to come in May. I don't think we're going to see a whole lot of evidence of it in the April numbers yet. Again, it's possible that a manufacturing recession may not even bleed over into the rest of the economy, even though consumers are really gloomy. So I'm surprised, but I think that's why the market here overall, we could continue to go through more of these, by the way, but I think that's why the market rallied. The market is sniffing out potential trade deals, but it's also this data that we're seeing where companies are basically saying, for the most part, it's not falling off yet. Is it going to? I don't know. Are we going to see a lot of job losses? Probably depends on that. You know, as gloomy as consumers are, for the most part, they're still spending. Royal Caribbean Cruise Lines bookings in Q1 outpaced bookings last year. And in the month of April, with all this tariff uncertainty and trade wars, their bookings were up in this April versus last April. And their onboard spending was higher on their current cruises than in prior years. They raised their full year guidance. So, I mean, that's pretty wild. Now, you had some other Starbucks is having a tough time right now. They're not executing well. They're losing market share. They didn't give financial guidance. That's a Starbucks problem. And again, the restaurant sector was a little bit weak. Like Shake Shack now expects low single-digit growth this year. Sales were down about 1% in April, but they've improved over the last couple of weeks. So it's kind of just it's not falling off a cliff there. Synchrony Financial credit card company customer activity remains stable. Spend levels still strong despite all the uncertainty. Visa has a wide view of spend. They said no signs of overall spend weakening. Some categories like travel have slowed, but overall spend remains strong. So that's pretty much it. I mean, that's a lot of the companies that have reported this week. I don't know if that was helpful. I don't know if I went on too long there, but just wanted to kind of give you the overall take on what companies are saying out there. Q1 results obviously don't reflect much trade war stuff at all. The uncertainty around the trade war has created a lot of uncertainty for business consumers, but we're just not seeing much economic impact of it yet. Could that still happen? Yes, but companies are not seeing it. They are planning for a wide range of potential outcomes out there. I'd like to see personally some trade deals signed and them to stop whatever they're doing with tweeting about rumors about them all the time. I think that's going to be key because every week that goes by where these tariffs remain in place, decisions have to be made by manufacturers, by businesses, by suppliers. There could end up being some shortages of certain products. Is that going to affect how consumers spend? Is it going to affect, could more people lose their jobs if, more parts of the manufacturing economy roll over? It's possible. But yeah, things are definitely a bit more resilient than we probably would have expected a couple of weeks ago. So that's where things stand as far as earnings season. Any individual stocks you want to look at? As we've got about 12 minutes here before the markets close for the week. Looks like we're going to close on a pretty strong note, although a little bit of a pullback here, kind of late in the day, which isn't surprising. We can always get like weird, what we call tape bombs or headline bombs over the weekend, where something unexpected, negative happens, and then all of a sudden we show up Monday morning and stocks are gapping down again. That's always a possibility. So some investors don't like to hold over the weekend. Traders don't like to hold over the weekend. That's understandable. We've also had like 8 or 9 straight days of the S&P up, I think. Wasn't it something like, yeah, because it even finished up on Wednesday after it gapped down. I think we've had like 8 straight sessions of gains in the S&P. So when you get to 8, 9, 10 days in a row of the S&P being up, statistically, you're a little more likely to see a down day. I can share this Google Sheet, yeah. Happy to share it. Let's see. Yeah, I'll share it. Why not? Let's see. Anyone with the link can view it. Why not? Because I love y'all. I don't know if it'll even paste in there. Let's see. I didn't put anything in Microsoft because they didn't really say a whole lot about tariff impact. But, they had a great quarter, by the way. The stock gapped up 9% after earnings. So, yeah, Mag 7, Mag 8 is doing pretty well other than Tesla. But even though Tesla's quarter was a real stinker, a real dog, the stock is up like, what is it, like 30, 40% from the bottom? Yeah. Who would have thought, right? Honey Badger stock, it just does not care about fundamentals in the existing businesses. It's all about robots. It's all about self-driving cars, I guess. Yeah. Yeah, Michael, I did talk about XYZ at the start of the stream, but just briefly to recap what I said. I think this is a bit of an overreaction. I was very disappointed that they had accelerating growth in Q4. They said that they were going to see continued acceleration of growth in 2025, and they had like a 30% growth in operating income target for 2025 entering the year. And then one quarter in, they pulled that guidance and said, it's only going to be 18% growth. And gross profit only grew 9% instead of the mid-teens rate we thought. So it immediately decelerated. They immediately pulled their annual guidance or took annual guidance down. So that's disappointing for a number of reasons. But, they think they have levers to reaccelerate growth in the back half of the year. I think it's just a show me story right now. The market wants to see proof because Jack Dorsey, he doesn't always execute on what he says he's going to. Valuation's very cheap. I'm not trying to sell here because it's trading for 10 times earnings. If they hit their revised numbers, they're going to grow operating income at a high teens rate this year. I don't know why you'd only be, paying 10 times earnings for that, even though obviously the optics of missing their guidance right off the bat in Q1 is not good. If you believe that they're going to be able to reaccelerate growth this year, or even if you just believe that they grow at 10, 15% on the bottom line again this year, then it's probably too cheap of a stock. And so this looks like a little bit of an overreaction. But yeah, go check that out. The beginning of the stream, I talked quite in depth about XYZ, aka Block, aka Square, aka whatever we're calling it now. Yeah, it looks like crypto remains strong. It'll be interesting to see how crypto performs this weekend. We are seeing some yield increases here. Surprised we aren't seeing a little bit more pressure on stocks given the rise in yields here. We have really not seen yields on the long end of the curve behave. This can become a risk again for the stock market. If we see yields, especially the 10-year and the 30-year rise, then that's going to be a problem for stocks because that's a key concern that foreign investors are selling treasuries, that the cost of financing goes up. If 30-year mortgage rates are benchmarked off the 10-year and the 30-year, and if the U.S. government has to keep refinancing and they want to get yields down, but yields are going the other direction, this becomes a bigger concern for markets. So we'll see how that plays out. So we are watching yields. I mean, it's nothing to be too spooked at right here yet, but noticing a pretty big move here today. That's something to keep an eye on. But yeah, it looks like we're going to close the week pretty strong. So next week, by the way, we are going to have, let's open up old earnings whispers here. They always post a good visual of companies reporting earnings. So next week, we get some interesting companies reporting, including a couple in the 100K portfolio that I'll be tuning in very closely to. So we have Palantir, Hims & Hers, Ford, AMD, Rivian, Datadog, Celsius, Uber, Carvana, Disney, Novo Nordisk, Shopify, Coinbase, Trade Desk, and a number of others. But yeah, I mean, I think, in the portfolio next week, I've got Coinbase, AMD, Uber. Those are going to be some big names. And then quite a few names off my watch. Oh, and Oscar Health also next Wednesday. So quite a few names reporting. And I think, yeah, it's going to be interesting to see what we hear from those. I think we have a pretty good picture overall of what companies are saying coming out of Q1. But some of these will be interesting to watch for, specific topics. Also, it'll be interesting to see how some of these stocks that have had a huge rally recently, like Palantir and Hims & Hers, will perform. Coinbase as well to some degree. Actually trimmed a little bit of Coinbase today ahead of the earnings report, just trimmed size a little bit. I'd been buying this as low as I think in the 150s at one point. In the 150s there at the bottom of the correction. I kind of was DCAing. So I took some profit, trimmed a little bit here in Coinbase today. I do have some small index hedges on as well. And I'm sitting on about 41%, 42% of the 100K portfolio is in cash right now. So very heavily defensive still. But, showing a lot more green now in terms of the unrealized P&L. I've got 28% unrealized gains in Wayfair now, 22% in Micron, 14% in TSM, 22% in the Bitcoin ETF, 18% in Coinbase. Although I think that maybe have been affected, the cost basis may have been affected by selling some of it. Uber's up 32% since original cost. A couple of stinkers in there, though, obviously. XYZ now down about 18% on an unrealized basis. Etsy down about 12% unrealized. And Abercrombie down about 24% unrealized. Luckily, Etsy and A&F are small. XYZ is not small for me. It's my second largest, 7.5% position. So 7.5, that's not terribly high, but it's certainly a core position, I would say. So I'm hoping that buyback goes into force and that square, aka block, really puts the buyback to good use here. Oh, you want to know about Costco? Let me tell you about Costco. I kind of want to short Costco, I'll be honest. It's hard to short it. It's real hard to short Costco ever. However, I mean, and it did break the 1,000 mark. So, these big round numbers on certain stocks like Costco act as kind of a magnet. And sometimes they act as support too. So now that it's above 1,000, this thing could run to 1,200, whatever number, and probably hold that 1,000 level for a while. Costco, I don't know, at some point in the next 2 or 3 years, this thing is going to have a slower than expected sales number, and it's going to have a 20%, 30% pullback. I'll tell you why. I mean, we're now trading at stupid multiples on Costco. Do we not care about valuation at all anymore? Apparently not. Certainly not on, and I can kind of understand why, because this is the kind of stock where it's like, it feels to a lot of investors like Costco doesn't have any risk. It doesn't ever miss its numbers. It doesn't ever have a surprise sales decline, at least not in a while, right? It's not pulling a Chipotle, at least not yet, where it's like growing, and then boom, it puts up a negative comp number. It's just been putting up sales growth after sales growth after sales growth every quarter consistently. But now investors, we recognized it was a good business 5 years ago, 10 years ago, when people were paying 30 to 35 times earnings, which is double what you're paying for the S&P 500. Now, today, even though people recognized it was a good business back then, it has had an even further multiple expansion. Its price to earnings multiple you're paying for it today is over 50 times. It's 53, 54 times this year's earnings estimates. Why do I want to buy this thing at a 1.5%, 2% equity free cash flow yield when I can go buy something that has a 10 or 12 or 15% cash flow yield that maybe isn't quite as quality of a business, but it's going to give me a 5 or 6 times free cash flow yield? I don't know. I can't buy Costco here. I mean, yeah, sure. Maybe it's a tough short at any price because it just consistently grows, but it's not like it's growing at that high of a rate. It grows, I think, like high single digits on revenues, low double digits on, let's look at what their current estimates are for this year and next year. Currently analysts expect 7-8% revenue growth this year, next year. Year after that, they probably grow 6-7% a year for the foreseeable future on the top line. And then that gives them, with a little bit of operating efficiency, the ability to grow earnings at 10 to 12% a year for like forever into the future almost. The reality is it won't be forever into the future because this thing will hit its saturated addressable market. In fact, one thing I think you have to worry about here with Costco is that you go into a Costco store in the US right now and it's pretty jam-packed. It's actually kind of a bad customer experience. Now, that leads me to believe there's probably an opportunity there for them to continue to open new Costco stores. So there is some opportunity there for expanding the number of Costcos maybe faster to meet that demand. But it's going to take them a while to do that. And frankly, I think it may be the case that we see, a little bit of slowdown at some point. That if you do get an unexpected slowdown in sales, and Costco does do, a significant portion of sales online, then you're going to have investors questioning whether or not it should be worth this 55 times earnings. I doubt people are going to be able to pay 55 times Costco earnings forever into the future and still be able to have great returns. So there's just no margin of safety buying it at 50 plus times earnings. I think if you could buy it at 35 times again, maybe 30 times for sure. 50, 55? I don't know. It's not for me there at that price. But I care about valuation. A lot of people don't. If you're a momentum investor, Costco is a great one, I guess. Celsius, they report next week. Yeah, let's take a look. It's been a battleground stock, right? Trading at a reasonable-ish multiple. Interesting acquisition they made of Alani Nu, one of their bigger, faster-growing competitors. The numbers have not been good for Celsius in the last few quarters. They had that really fast ramp for a couple years, and then growth just ground to a halt it turned out that they had flooded their distributors with so much inventory that at a certain point, the point of sale people were like, look, it's not selling as fast as you're sending us product. And so like, we're going to slow down our orders and you guys need to figure out what the true demand is for this product. And so, I mean, yeah, look, they had quite a run, right? They were growing 50 to 100% on the top line for a number of quarters throughout 2022, 2023. It's like hot brand, on trend. PepsiCo, one of their partners, was just pumping more of the product into convenience stores and grocery stores and all their points of sale. So not only are they benefiting from consumers buying product, but they're benefiting from all the stocking of new point of sale where they have putting inventory. Then all of a sudden it ground to a halt and the distributors were like, hey, we got too much product. Consumers like it, but they don't like it that much. Boom, you go from growing massively to shrinking. They had a quarter where they were down 30% on a year-over-year revenue growth basis. So now you're kind of in this chop period. It's like you're growing a little bit. You grew a couple percentage points last quarter. You are growing internationally still, so there's still a lot of room to grow international. But the question is, can the U.S. market grow again? Do they just go through this transitionary period? I feel like the energy drink category is quite crowded. One of the best performing stocks over the last several decades is Monster Beverage. Look at a long-term chart of this thing. Jeez Louise. One of the greatest compounders in stock market history in the U.S. over the last few decades. It used to be called Hanson Natural back in the early 2000s. It used to be a penny stock. Now it's a multi-billion-dollar, tens of billions of market cap. Has been a crazy success story. So Monster Beverage, obviously, the one of the big success stories. You also have Red Bull, very, very prominent internationally, globally. You've got new upstart brands like Ghost, which got bought by private equity recently. You had Alani Nu, which Celsius just bought for a couple $1 billion. And I actually thought the Celsius deal for Alani Nu wasn't horrible. I mean, they didn't pay a cheap price, but they didn't pay a crazy price. It was a reasonable-ish deal for Celsius. The question is, they buy Alani Nu. Is Alani Nu a brand that has like long-term staying power, or was it just a flash in a pan? The same could be asked of Celsius. Is it just a fad? A lot of people are questioning the amount of caffeine in these drinks, if they're safe to consume. A lot of teenagers. There's been some cases where people have had like heart issues because they're drinking too many Celsiuses. I mean, the same could be true of like Red Bull and Monster. I'm not so worried about that as much as I am. Maybe people care about their health more. They start to question, even though these things are low sugar, they're high in sugar alcohols. Maybe that's playing a role. We've seen some articles out there. I don't know. I don't know if that's really going to affect them long term. I think the real question is the brand a fad or not? Or is there a core group of customers that can continue to grow and buy these things? I think there probably is. I think this business can definitely grow here as they kind of digest this period of like over shipping product. Now they get to kind of a more stable level of product, more stable distribution points. I do think international still remains an opportunity. This to me seems like a business that should grow 10 to 12% a year for the next, 5-6 years at a minimum if they execute correctly. I haven't really spent a lot of time looking at the management team here. So that's a real question. It's like when you need a management team that can execute, that's something you have to look closely at. Is this the right management team for the job? It's a profitable business. It's a proven business. The balance sheet is decent. The Alani Nu acquisition will add, I think, some debt, right? I'll have to double check that, but it's at a reasonable-ish valuation. It's not at a screaming cheap valuation, but it's certainly not like a crazy valuation. I think currently analysts estimate they will grow solidly for the next few years. They'll see some bottom line progress as well. You're talking potential for, and the revenue growth number here this year does reflect Alani Nu. So this 55% sales growth number is not an organic sales growth number. Important to make that distinction here. But analysts think they grow 10 to 20%, a year, for a couple years after that. There aren't that many analysts that cover it, but still. So, could they put up, $2 of EPS in a couple years? It seems potentially doable, and the stock would be trading, at this price at a pretty reasonable multiple of a long-term earnings power. Now, Doesn't look, again, it doesn't look quite as cheap on a near-term earnings number. Analysts expect about $1 of earnings in the next year or so. So you're buying it for 30, 35 times earnings. It did have kind of a cult stock following. So because of its massive run, because of what some of its peers like Monster have done in the past, people are like, okay, this thing went parabolic before. We've seen what Monster did long term. If you bought Monster on some of its big pullbacks, you would have done very well. I'm kind of into Celsius. I'd want to do some serious work on it, but look at these pullbacks. Monster had some gnarly pullbacks. It went down 40, 50% several times. Had, a couple years too where it went nowhere. It chopped around from 2018 to 2020 before it took off again. In the early days, you can see it had, it had quite a few big pullbacks in the early days. So, is that what's going to happen at Celsius? I do think the category is more crowded these days than it was back in Monster's rise to prominence. So I wouldn't expect it to potentially do exactly what Monster did, but I do think there are some similarities. I think you got to wait for the right price, wait for market corrections to buy it. 30, 35 times. I think you can still have a decent longer term return, but you better be prepared for some pullbacks when things slow down, when the consumer slows down. Ideally, you'd love to be able to buy this at sub 20 times earnings. If you could buy this for a below market multiple when investors are worried about growth slowing down or worried about the overall consumer, I think that gives you a little bit more margin of safety on this one. So I don't know. I'm cautiously positive on it, but I don't think 35 times is that interesting. But we'll have to see how they do on their first earnings report here of the year. But yeah, hey, Mala said it. Selling addictive drugs is usually a pretty good market, whether it's like cigarettes, whether it's booze. Although the volumes of booze are starting to decline, have started to decline. But nicotine, although cannabis has not done well, but that's got its own set of issues. Look at Philip Morris, one of the best performing stocks this year, over the past year. What is it up year to date now? Philip Morris is up 40% year to date. I think it is one of the best, if not the best performing stock in the market this year. A big part of that, of course, is the vape and the smokeless products that have been taking share. There's obviously a big story there, but these stocks go through these periods too, where they go through regulatory backlash, then it's quiet for a few years, then you get more regulatory backlash. There was the big Juul, the whole big Juul ban a few years back of the Juul flavored pods and the big antitrust against Juul and DOJ case against Juul. And then, these things trade for sometimes like 8 to 10 times earnings. And then the multiple expands when investors are less worried about the regulatory. Trading now for 20 to 22 times earnings. Let's look at a graph real quick. The price to earnings multiple on Philip Morris. I think where I see a similar set of stocks right now, by the way, is in pharma, big pharma. I think big pharma looks a lot like tobacco did a few years ago. Today, I think big pharma, there could be some opportunities within big pharma right now. But yeah, look at this thing. I mean, let's look at a longer term 20-year chart. Make sure this is set on linear. So, yeah, I mean, for long periods of time, this thing would trade for 10 or 12 times earnings. Long periods, multi-year periods, or at least sub 15. I mean, for most of the last 2 decades, it traded under a market multiple. Yeah, and in a lot of cases, there are plenty of time periods where 12, 13, 14 times earnings was the norm. So now today it's back up at kind of a multi-year or near a multi-year high in the price to earnings multiple. So valuation has expanded again because they have had pretty good growth in some of their non-traditional, non-cigarette products. It was thought for a while that, one, you got all this regulatory backlash, but two, you have the core cigarette volumes in decline. Yeah, they're raising price over time, but their customers are slowly dying off. But now they found another growth engine in things like vapes and Zen type products, the smokeless products. So it is interesting. This is a perfect example of how a lot of companies sometimes like look like they're just slowly melting ice cubes, and then they find a return to growth, and all of a sudden the stock becomes a massive winner. Microsoft is one of those examples. It's hard to remember. Most of you may not remember if you weren't in the market. Back in the like early to mid 2000s, Microsoft stock went nowhere for like a decade. It used to trade for like 10 times earnings, 12 times earnings back here. I guess it really started to take off again in like 2012, 2013. But look, post.com bust from like 2001 through 2013, the stock was nothing. It went nowhere. I think it had a little bit of dividends, but like your overall return might have been negative for a decade. And then, you know, they of course launched Azure. They started to see growth in Windows and Office again. Value Act played a really good role there, and as an activist investor. Let's look here. Microsoft. It's funny though. You know, I'd say there's at least one or two stocks in my portfolio that probably look a little bit like this today that people do not believe in, that I think could return to growth one day. And are not priced for growth, and so therefore that's the potential where you get the multi-bagger potential. But yeah, Microsoft back in like the 2000. So after the .com bust, it took a while, but it just kept steadily declining in terms of valuation. But I remember looking at it in like 2010, 2011 when I was at the hedge fund. And yeah, this thing got down to like 9 times price to earnings multiple. Imagine being able to buy Microsoft, which is now today the largest company in the world by market cap at $3.2 trillion. Imagine being able to buy Microsoft at 8 or 9 times earnings. Today it trades for 30 times forward earnings. And is growing at a really nice rate and has just been a monster stock to own for the past few years. But imagine how, you know, pessimistic people were back here. The valuation and the stock price were just in decline. People were like, this thing is dead. Windows is dead. Apple's taking market share. Azure didn't exist yet. Xbox was like, it was okay. Windows is going to be around in 10 years. People weren't sure. And then, boom, then it becomes just an absolute stellar performer. Top of the world, largest market cap in the world is a public company, right? There's a few other examples like this as well. But that's why I always try to like think forward like 5-10 years or even just a couple years. It's like, okay, what companies are underestimated that, you know, the market thinks are boring, old, stodgy, never going to grow. You got to be careful though, because like some companies do, like Kodak, for instance, or like Hertz, or, you know, some of these companies that just like they're just never going to make it out probably. I mean, I don't know, like how does Hertz survive in a world where you've got like autonomous vehicles and Uber thriving? And I mean, maybe there is a world, but Hertz it's tough. But like Kodak's, like BlackBerry, another good example, right? There are businesses that just die off. So you have to be careful. It's like hard to differentiate. Is this business going to be like a melting ice cube that truly is going to die off? Or can they find these like avenues for growth again? I think the key is like, you don't want a company that has a ton of debt on the balance sheet, because that's going to like limit their capabilities for, you know, trying new things and trying new avenues for growth. You don't want companies that are unprofitable. They just don't have enough of a runway from a time horizon perspective to be able to try other things or get things moving again or hire people or take big bets. So you need companies that are cash flow positive, profitable, you know, cleanish balance sheet. I think that's a big part of finding the ones that maybe look boring, look like they're not going to grow, but still have the potential to hit a new growth path at some point. Yeah. That's why I look like companies like Wayfair or Etsy that are in like a cyclical downturn. And I would say Etsy and Wayfair don't have like the greatest balance sheets. They both do have a little bit of debt. But Etsy generates really, really nice cash flow, 650-ish million of free cash flow a year right now, even though merchandise volumes have been in decline for 2-3 years since COVID. The Depop business at Etsy, by the way, is kind of a sneaky grower. Like Depop, the resale app that they own, that they bought a few years ago, They probably paid too much for it, but it is actually performing quite well now. Let's see, Depop, I think, let's look at, this used to be called App Annie, but I think now it's called Data.ai. Here, let me see if I can log into this and at least look at some free data here. Yeah, the interesting thing is like Depop, even though it's a smaller part of the business, has been growing really, really nicely, kind of quietly in the background for Etsy. Let's see if I can pull it up for you. Depop. But yeah, it's an apparel resale marketplace, which, in a terrible tariff trade war environment might actually be able to pick up some more market share as well, because people, if there are less available things or things that are on the shelves are way more expensive than they used to be, people may look to do more reselling. It's actually really big in Japan as well. The reselling of goods and buying used goods is a pretty big trend. Hard to tell they only give us 90 days of free data here on data.ai, but Depop is ranking in the top 15 in the US shopping category. It was not that way a couple years ago. So this is a pretty nice little asset for Etsy. I do think they got to figure out how to grow the core business. They're working on some app updates. They're working on some stuff like that, but they got to figure out how to reaccelerate the top line growth for sure. But you're buying it for 8 times free cash flow right now. So, I mean, it's not priced for growth. So if they ever get back to growth, this stock should take off. Oh, Hims. Yeah, Hims. Good question on Hims. Hims. Oof, man. What a beauty. What a beauty. It pains me to look at the chart because I bought this stock $6-ish after the SPAC implosion. Nobody even knew about this stock. Like, I don't think very many people had this on their radar. This was back before it became a cult stock. This was in the post-SPAC bust when all SPACs were being sold off in 2022. And Hims was still growing at a really nice rate back then. It was like getting no love from the market. I think the market just was like, yeah, it's overvalued. It's just like a little penis pill app where guys can get Viagra or hair loss pills, which it was. However, you could see if you spent a little time digging into the platform, even back here, or even back at the time of the SPAC IPO, it was like, well, actually, they're going direct to consumer. They're making it like very cost efficient, it's just a very good consumer experience. And there's all these different categories. They bought like a dermatology app. So they were like expanding already into some of these other modalities. And you could see the path. You could see the path to like being in all these different verticals of health and offering different products and different pharmaceuticals. There was always a question of, are they towing the line, of safety too closely? Like, it is really easy to go on the app and get a prescription very quickly. I mean, that's a valid criticism. Even today, I think it's a very valid criticism. So, like, you have to be careful because some of these, app-based companies that have enabled easy prescriptions got themselves into real trouble with things like ADHD meds and psych meds and things like that. So, I think, that's always going to be a risk here, I think, for Hims and Hers. And they got some flack after the Super Bowl ad this year, even for that. So, but I could see back here, I was like, okay, there's something interesting here. The market's not pricing it at a super high multiple, but it's growing very fast. It's a washed out SPAC. I started buying some, but then I ended up selling. I think I sold it on the scale out. I think the last I sold was like in the high teens or low 20s. And then of course it went to like 60, 70 at one point. It went parabolic. It's become a bit of a cult stock. People love the CEO. People love the stock. It definitely got overvalued there. A big part of this story recently that I didn't see back in the post SPAC boom or post SPAC bust time frame was the weight loss drugs. So the semaglutides, the whole weight loss drug market was not on my radar back then. So that's one of the reasons why I missed this big run up. But as we look at it today with fresh eyes, the big piece of news this past week was their partnership, which is very, very meaningful, by the way. Because it does de-risk one of the big bear cases on Hims, and that was their partnership with Novo to offer Wegovy on the Hims platform. So Wegovy is one of the big brand name weight loss drugs, and because it went off of shortage a couple months ago, Hims had to take it off the platform because they were offering like a generic version. So Hims was able to offer a generic version when the product was in shortage, but once it went off shortage, they couldn't offer that same generic version. However, even though bears thought that meant the end of Hims and Hers' ability to sell these weight loss drugs, Hims did a great job. They went over to Novo and said, listen, we have a lot of consumers. You want to sell your product. Let's make it available on our platform. Novo said, yeah, our stock's in the dumps. Why not? By the way, some of Novo's patents on some of their weight loss drugs start to expire here in the next couple of years. And that, I think, is one of the reasons why they decided to offer it via Hims. They're going to need a lot of channels to push their product out to try to keep that brand name and keep that market share high, because there are going to be more compounded and generic versions of Wegovy created in the coming years. There's also going to be a lot of competition from new drugs in the weight loss category that are being developed by Viking and by Lilly, and all sorts of smaller players as well are developing GLP-1s and all the different variants now. So it makes sense why Hims and Novo would partner. They both kind of need each other here. But it's a big deal for Hims because it gives them a brand name weight loss drug they can offer on their platform. Weight loss drugs are going to be, if not the biggest blockbuster category of drug of all time, then certainly one of the top 2 or 3 behind, maybe Viagra. Although I think it'll be much larger than even Viagra and some of the other blockbusters of the past few decades. So when you look at Wegovy and Mounjaro and tirzepatide and all the different versions of these weight loss drugs, and you put them together, it's definitely almost certainly going to be the biggest pharmaceutical market in history. And so our obesity problem, will it be solved? I don't know, but this is definitely a big one for Hims. And so, I mean, it makes sense why the stock gapped up. It's not even that crazy expensive here. And in the 30s, in the low 30s, this was before they did the deal, obviously, but it was trading. I mean, analysts currently have them doing $1 of earnings this year, but as high as $2 in a couple of years. So, I mean, it does look like you're trading, almost 40 times earnings this year on this year's numbers, but growing so quickly that you could be at a reasonable multiple in 3 or 4 years. And this company has just been growing like a weed on the top line, and they're profitable. Some people believe this can be a consumer health platform that, is valued in the tens of billions when you look out 5, 10, 15 years, which I can kind of understand that bullishness in the sense that the healthcare system in the US sucks. And if you offer a really consumer-friendly platform where consumers can get much easier access to, to treatment options and even things that aren't pharmaceutical, maybe things like skincare and all that, you could build something very, very meaningful. But there's still a lot of execution that has to happen between now and there. It's not a given that that's what that's going to look like. How much of this market can they really take over time is a key question. Hims is going to be a battleground stock, I think, for a while. I think you have to be a little bit patient on this one as well and buy this one on pullbacks. Kind of reminds me, we were talking about Monster earlier. I do think it can be one of those stocks that over time has a really nice growth chart, on a long-term chart, but it's hard to see it. But you're going to have a lot of pullbacks that last months or quarters at a time along the way, because you are in a regulated industry. So you're going to have regulatory backlash, unlike Monster, which wasn't even in that regulated of an industry. You have big players. Health insurance plays a big role in consumers' access to care. Doctors have a lot of lobbying efforts as well. There may be advertising issues that Hims faces. So there's going to be scrutiny on the company. I think there's going to be pretty gnarly pullbacks. You are dealing also with a cult stock where you have, this ability to go to a really high, crazy overvalued multiple, but also back down oversold, in very, very quick time frames. So you can get whipped around on the stock very quickly. I like the company. I like the CEO. I like the long-term opportunity, but I do think you gotta be a little bit careful when and how you buy this thing, unless you're just trading it for a short-term time frame. I think because there is some risk, wait for some pullbacks, even on shorter term time frames. I do like the partnerships they've got. They de-risk part of the bear case this week. It's not like Palantir expensive. This thing can go a lot higher. It is a cult stock. You get in the right market environment. Palantir's trading over 200 times earnings. Hims trading for 40 times, right? So I'm not saying Hims should be valued like Palantir, but could Hims go from 40 to 60 times earnings this year? It absolutely could, for no reason at all. So I'm not saying it will. I would rather buy it on a pullback myself anyway. But I also don't want to underestimate what it can do in terms of upside because of that cult stock status, and its total revenue growth rates are so high. So yeah, I like the positive news that it got with the partnership this week. I was very very happy to see that. I wish I had owned it. I think I own a tiny bit of it in like one of my kids' accounts, but that one I'm just kind of trying to hold forever. Longer term chart, like look at the weekly here. I mean, maybe you get it on a little bit of a pullback here, but longer term, the trend is still higher here. So I think from a technicals perspective as well, looks pretty interesting. What's the RSI like on this bad boy right now? Is it like overbought? Yeah, it's a little bit overbought too in the short run. I mean, it's had a big recovery in the last couple of weeks. This thing's trading at a pretty high RSI. So I think short term you could get a little pullback here, especially if we get a little pullback in the market. What else? What else are y'all looking at? How are things going for your portfolio this week? Did you buy the dip? I bought the dip. Apparently not enough of the dip, but I bought the dip. I got scared on a few things. I bought the dip on some stuff and then like sold it pretty quick. Like I let go of my Airbnb and a little bit of Amazon. But for the most part, I DCA'd into my core positions and have kept most of those core positions. I've trimmed a little bit around a few of them. Like I trimmed today a little bit of Coinbase just ahead of earnings next week. It's still about a 4% position. Plus, I've got Bitcoin exposure via IBIT, which is up a nice 23% since I bought it. Semis are doing well again. So obviously we've seen, by the way, from this Q1 earnings that the AI boom just continues. TSM had nothing but positive comments to say about the demand environment. We're seeing anecdotes about Micron, which I own in the portfolio. They're continuing to see price increases on memory contracts. I'm expecting big things out of that stock still. We don't get a report from NVIDIA for a couple of weeks, but it seems like things are still going well there. You've got a big recovery in stocks like Vertiv, which reported, Vistra as well. So some of these AI plays have had really nice recoveries off the bottom. And basically, like most of the companies that have, most of the Mag 7 also said that they're still planning huge CapEx increases this year for AI spend. So Meta actually upped their CapEx guidance again. Let's look real quick at the transcript here. If you look at Meta, they basically said, what did they say? Yeah, they said, as far as their guidance for CapEx, they were already, I think, planning to like double their CapEx from the prior year. We anticipate full year 2025 CapEx will be in the range of $64 billion to $72 billion, increased from our prior outlook of $60 to $65 billion. And the $60 to $65 billion is versus last year's full year number of, let's look at the cash flow statement. That's where we'll find the CapEx they actually spent. Purchase of property and equipment, they spent $37 billion here. So they spent $37 billion on PP&E in 2024. They were guiding to 60 to 65, which was almost double. That was what they guided to at the end of the fourth quarter. Then here in the Q1 report, they came out and they said, "Oh, actually, we're going to increase our CapEx guide again to basically double what last year's number was." So this also happened with Google. Google said, and Microsoft, even though Microsoft has had they've moved some capacity from some data centers they were planning to some others, but basically their spend is way up this year on CapEx. So most of the Mag 7, Mag 8 are spending significantly more this year on data centers, infrastructure hardware than they were last year even. And last year was already a big boom year for AI. So even though these pulled back really hard with the overall market, let's look at the stocks real quick. The AI boom story is not over, at least not yet. And the stocks, honestly, could have further to recover here. But I like my preferred names. I was able to buy TSM at like 14 times earnings at the bottom, Micron at 7 times, 8 times earnings at the bottom. Still a lot of potential upside ahead. I mean, I think Micron could be a $150 stock by this time next year. We'll see. A lot has to go right still, obviously, but I do like those positions. Gold, man, gold's yeah, it was due for a pullback. Let's be honest, right? I mean, it was due. Like the RSI was hitting like 90 or some ridiculous number, right? I think it was like 80 or 90 at one point. I mean, it was gapping up every day for like 2 weeks. Yeah, I mean, look at these gaps on gold. This is just the GLD ETF, but it was due for a pullback. The thing was up 50% in the past year, which is just an insane move for gold. What's it up now over the past year? It's up 40. That's still a really good performance. I mean, I own a little bit in some of my legacy family portfolios, not in my 100K portfolio. I wanted to pull back a bit more before I buy some gold in the 100K portfolio, but I don't hate it. I like having a little bit of gold. It's actually a pretty nice hedge in the portfolio for like a stagflationary environment. So I like it for that role, especially right now with that being a risk. But I'm having trouble figuring out what my entry price is on gold. I don't know. You tell me what you think. It hasn't had that big of a correction. Where's the 200-day on gold? Let's look at some technicals. I'm certainly no expert in technicals, as anyone can attest, but I mean the 200-day is all the way down at what, 250 on GLD. We're a ways from there yet. Let's look at the 50-day and the 20-day. Yeah, I mean, you're still pretty far above. You haven't really tested any of these key longer-term moving averages yet. Shorter term, you did get a bounce there off the 20 or 21. Or at least you're attempting to bounce off of it. So maybe there's a shorter-term bounce. I don't know. I kind of want to wait for a retest of something a little longer-term there before I'd add it. It was so overbought. When you have the indicator, the like cab driver indicator, the Uber driver indicator, or your aunts and uncles calling you, hey, should I buy gold? That's when you're like, it's time to trim a little. It's time to trim a little gold, I think. When everybody and their grandma is asking about should they buy it. It's like, dude, you missed it. I don't know. Like, you should have bought it 2 years ago. What are you talking about? You should have bought it 5 years ago. Like, now you want to buy it when it's parabolic? Come on. That's not how it works. Oh, Justin's asking about Rivian and ETH. Yeah, ETH. Man, ETH. So ETHA, the iShares Ethereum Trust. It's basically like the IBIT, but it's the one of the bigger ETFs that hold Ethereum that are publicly traded. So yeah, I mean, it's a play on Ethereum. It looks kind of interesting, honestly. Like I'm not in the weeds right now on what's happening with Ethereum and the development. I know price action has been horrible. It's lost some share to Solana. There's some questions about, can it scale long term? Can it be like the true chain that provides tokenization and smart contracts and all these things that were promised, and all these other layer 2 scaling solutions that were brought on that are connected to Ethereum are supposed to solve some of the key problems, and yet it hasn't really happened for Ethereum yet. There's some infighting with the Ethereum Foundation, some big questions there. I'm not in the weeds on all that, but I'm kind of like vaguely aware of it. I think you make it a tiny position. I can make a case that because it has that historical correlation to crypto and particularly Bitcoin, and it did look like it was a bit oversold recently, I might be willing to give it like a really small allocation as like a very high risk, high reward play. To be quite honest, I kind of got into I messed around with some meme coin stuff last year, and I realized like Solana and the DeFi ecosystem over there was pretty good. and a lot cheaper than trading on the Ethereum chains. And so I was like, this is kind of a better mousetrap. I would rather buy Solana in a deep correction, 40% off than Ethereum, to be honest. And so Solana is kind of interesting to me for like a longer term buy and hold play in crypto, perhaps. But my business partner is Chris Dunn. He's kind of he's much more of a technicals and price focused trader, but I think his approach is probably worth a lot more than my takes on crypto, to be honest. I'm very much I like the scarce nature of Bitcoin, and I do like the potential for certain assets like Solana that have proven they have like a high throughput capabilities for some of these other applications that we've long been promised. But on a day-to-day, week-to-week, can you make money trading it? I'm probably not the right guy for that insight, to be honest. But I do have some interest in Solana. I do think Ethereum, from a risk-reward standpoint, if it's not going to totally die out, this could be interesting here. Yeah, not in the trenches anymore. I haven't traded any meme coins in a number of months. Just kind of like meme coin ecosystem it got pretty tough there, right? And I sort of got busy with other stuff, but I do think that meme coins are not going away. I will say that. So the next iteration of the meme coin boom will be interesting. I think tokenization, obviously people keep talking about that, but that's going to be very interesting too. When you imagine the whole meme coin fervor, but put real assets on those chains that are tradable. That's where it gets really interesting. Like people will start bidding up real assets the way they did meme coins, and you can actually have like fundamental anchors of value. That could be very, very interesting. That's what'll get me really excited. Yeah. I don't think I could put more than like 1% of capital in Ethereum right now, though. Just too many long-term questions still outstanding. But from a risk-reward perspective, I can understand the trade idea. Like it's definitely had a massive pullback, underperforming massively. It's kind of broken its historical correlation with Bitcoin. If it could regain some of its previous momentum, this would have a lot of upside. But I think you got to size it super small given what we know right now. And the Trump family does hold it, and they have tried to pump it. At least one of the Trumps, right? Was it Eric or one of the sons? That is an interesting angle. I do agree. Someone was asking about Amazon. Yeah, so Amazon, it's tough. I think if you buy Amazon today and you hold it for 5 or 10 years, it works out just fine. Will you be able to get it at a cheaper price than today? I think that's also reasonably likely. The retail business, I think I was surprised that they weren't. I was surprised at how positive they were on the conference call for Q1. And I'll just pull up my comments here again. And they said, what did they say? This is just a summary of some of their comments. They haven't seen demand slow down, and they're not really seeing price increases from suppliers. And by the way, they also think that, because they have so many suppliers on the platform, any massively affected suppliers that go out of business or can't offer their products or try to raise prices too much will get replaced by suppliers from other regions or suppliers that choose not to raise prices, things like that. So, and I can see that possibility for Amazon, but I also think that, there's probably some of their advertising revenue that will take a hit in the short run. And, if we stay in a really nasty tariff war, I do think Amazon is one of the more exposed of the Mag 7 there. To some of that disruption just in the core business, and they could get stuck with some inventory charges perhaps, or on first party inventory. So there are some things that could still happen here in this trade war issue with Amazon. Obviously, you've got the AWS business and the AI stuff that's happening, and the other components of the business that are still doing well. And I think that's going to help the business from falling off a cliff, even if we do go into a recessionary time frame. But It's not like super screaming cheap. You got to look out a few years, but Amazon never really trades at a cheap multiple on like existing earnings numbers. Um, so it's kind of hard to figure out like where it should be valued. But I mean, it's trading for a higher multiple than the rest of the Mag 7, most of the Mag 7 right now, except for I think Microsoft. So yeah, it's one of those where it's like it's kind of the one that's more exposed on the retail side of the business to some of these issues with the trade war, and you're not yet trading at like the cheapest multiple of the group. So I don't know. You kind of want it to be cheaper, I think, before you really get like super super bullish on it. I do think Amazon's such a heavyweight in e-commerce. Like it's just it's kind of like Costco for the online retail world in that like will they ever not grow? I do think AWS always offers that opportunity for things to kind of slow down on the enterprise side where you might run into some slowdown or the business just getting so big at some point there that you just naturally see a slowdown. But the retail business just seems like it grows forever without like really any end to that. So that's one thing to really like about Amazon on a long-term time frame. It's like, I mean, if you have a very long-term holding period, it's hard to imagine it not working out on Amazon because you're not buying it at a Palantir multiple, so that's good. So maybe I'm being a little bit too price sensitive, saying, you kind of want to buy it cheaper. If it did get down to 20 or 25 times current year earnings, I think that would kind of be a no-brainer. But maybe that's why it doesn't get there, is because that level becomes such a no-brainer that it never quite gets there. But yeah, I think if you have a long enough time horizon on Amazon, it works out from here. You may have to work through some chop in the near term. We're going to get a lot of interesting whipsaws and headlines here in the coming weeks still. We're still waiting on trade deals to get signed. We're still waiting on what is the resolution between the U.S. and China situation going to look like. That could still be months or quarters away, so things could get worse before they get better. So that's why I'm kind of a little bit cautious on Amazon. It might cost me in the sense that like paying up for that certainty of seeing the skies clear a little bit is going to mean that the share price will be higher at that point. That could very well be the case. That's the hard part. That's what makes investing so hard. It's like when everything is known, when the skies are clear, that means you're going to be paying a much higher price. So do you buy with and accept the uncertainty, or do you wait? That's a hard question to answer on certain stocks. For certain stocks, it's easier than others, right? If you're buying something at 7 times free cash flow, well, it's like there's way more upside risk usually, unless that business is totally in decline. There's way more upside potential there than downside potential. But if you're buying a business at 100 times earnings or cash flow, then it's the opposite. It's like, oh, one little slowdown and that thing's down 20%. We're context switching so fast. Yeah, sorry. That's how my brain kind of works on these live streams. I'm just like jumping all over the place. But yeah, you're saying that gold, de-dollarization and uncertainty are like strong tailwinds. Yeah, I think you're right. The de-dollarization though, I think it happens a lot slower and a lot over a longer time frame than people are perhaps assuming. Like the dollar declined 9.5% through the first like 3.5 months of the year. That is like a historic, and now it's only down about 8%. But that's still a fairly big move for the dollar. And because the U.S. economy is so large, there's no way for other economies to totally decouple from the U.S. right off the bat, even if they want to. Even if Canada's pissed off at us, even if Europe is pissed off at us, even if Asia is pissed off at us, which they are for good reason, their businesses and consumers are inextricably linked to the U.S. economy, the largest economy in the world. And so the ability to de-dollarize is essentially impossible on a short-term time frame. And so I think when you see like a 10% move down in the dollar, obviously, a lot of that is investor-related outflows. Like you have pressure on the dollar because a lot of investors, international investors, were over allocated to US markets. And so when US assets start going down and you have the dollar going down, it's kind of like the Japanese yen carry trade unwind of last year. You have a situation where, man, it's a double whammy for those foreign investors. All of a sudden, they're getting hit on lower asset prices in the US, and they're getting hit on the translation back to their home currency. And so they're like, shit, get me out, get me out. And so it's kind of like a panic drawdown in the dollar to me. I do think longer term, there's probably decent more room for the dollar to fall against some currencies. But you also have to ask the question, like, against what? Certainly against gold, there's probably more potential for the dollar to fall. But like the DXY is also interesting because you look at like, would you rather own yen? The Japanese have a 220% debt to GDP ratio. We're still only at like what, 130, 140 in the US, which is still quite high, but like the Japanese are even worse. The Euro, the EU region, they're committing to increasing their budget deficits. They've got lower interest rates than we do right now. So do you really want to own the Euro? You think the Euro is going to, really be the place to have your capital parked, right? And so de-dollarization, I think, is very difficult for major other parts of the globe. When you look at other currencies, like it's like where else is that capital going to flow? But of course, hard assets, scarce assets like Bitcoin, like gold, I do think, continue to do well over time in a world of heavy fiscal spend, debasing of currencies more broadly, not just the dollar, but the yen, the euro, all these countries that are printing money over time. I think that's why you have a bid under not just gold, not just Bitcoin, but also stocks, honestly, because stocks are, they are nominal growth assets. And so they have historically had a spread that they've returned well over inflation. And so that's why I always say, like, you got to be an investor if you have capital, because, otherwise you're just getting debased over time. So that is true. But, again, gold is up 40%. Let's look at the gold futures. Or we'll just look at GLD. I mean, gold's up 40% over the past year. Is the dollar debasing at 40% a year? No. So you pulled forward some of that debasement return. So that's why I say I think like you got overbought on gold. And again, I think it could easily pull back to a longer term key moving average like the 50-day or the 200-day, which would still be another, 10, 15% lower. But yeah, it's always interesting thinking about currencies, because currencies themselves are relative. It's like relative to what would you rather own than the US dollar? There's not a lot of currencies that come to mind as a clear, obvious winner. But when it comes to other assets outside of currencies, for sure, gold, Bitcoin, stocks, you gotta have some of all that, I think. Yeah, Lucas, I talked about hims and hers earlier. Actually, we've been going for a while here, almost, hour and a half-ish, hour and a half. Yeah, I think I may wrap up here. I've been a little bit under the weather, so save the voice for another time. But yeah, it was fun chatting stocks, chatting earnings. We talked a lot about what companies were seeing on what they were saying about Q1 and trends in April from the Q1 earnings call. If you want to go through some of that, we talked about that earlier. We talked about a number of different stocks. We talked about HIMS. We talked about the big whiff from XYZ block. Painful for me today, as it's my second largest position. Definitely feeling the pain on that one, but hanging in there. I think maybe a little bit of an overreaction. Talked about some of the Mag 7. We talked about a lot of stuff. Talked about gold. Talked about the macro. Yeah, it'll be interesting to see what happens next week. I mentioned, we've got more earnings especially from some of the mid-cap tech stocks, some of the software companies reporting. But we've also got, do we have a Fed meeting next week? Did I skip over that? Let's just double check. I forget exactly when it is. I know it's coming up in May. Let's look what we've got on the calendar. Yeah, we do have a Fed meeting next week. I thought so. That'll be interesting. I think we could see market pause or a market chop ahead of the Fed meeting, perhaps.
What do you want to call it?
We've had, I think, 8 or 9 straight sessions of the S&P 500 in the green, despite the fact that we don't have any signed trade deals yet. So we're pricing in already now a lot of optimism over the trade war situation. So I think it's time probably for a little bit of a pause in the indices ahead of some uncertainty around the Fed meeting. I could be wrong. Maybe we get a positive trade deal signed at the beginning of next week or over the weekend. That could always change things, but it wouldn't surprise me at least to see some chop ahead of the Fed meeting. We need to get some more clarity. Companies are telling us they're planning for a wide range of outcomes and they don't know what the hell is going to happen, and so we don't either. Let's find out. Apollo, I mentioned this earlier this week, but Apollo, basically the private equity firm Apollo, their chief economist Torsten Slok, who puts out a lot of really great charts and data on their Apollo blog, he posted this 40 slide deck, basically laying out the case for recession. And Apollo, at least their chief economist, thinks that recession is almost a certainty at this point for the U.S., saying that by the summer we'll be in recession. So I said earlier on in the stream, my general view is I think we're definitely going to be in recession in the manufacturing sector, but the manufacturing sector is only 10% of the economy in the U.S. The real question is whether or not that spills over into the 90%, the services economy, via cascading job losses. We just don't know yet. We have not seen significant evidence of that. Certainly the unemployment report today looked pretty good, did not suggest that we're seeing massive job layoffs in April. So far, we have not seen that spillover. Apollo thinks that spillover will happen if this trade war remains in force without a resolution. So that's their view. I don't have a strong view either way. I'm going to try to just react to kind of how things shake out, and not try to predict exactly what's going to happen in a very, very unpredictable geopolitical scenario. But yeah, I do think Q2, Alan's mentioning Q2, if we are going to see weakness in the economy, we weren't going to see it in Q1 numbers. We will likely see it. If there was pre-buying by consumers in April and they start to taper purchases in May and June, then we will see those numbers show up in the Q2 numbers. But it could be weeks or months before we really start to see a lot of hard evidence of that. So we'll be monitoring the data, monitoring what companies are saying, monitoring it for any guidance changes from companies that guide down between quarters. But a lot of unknowns still. But the market has had quite a heroic rally. Where we go from here, I cannot say, but I think the risk reward is changing again. I do think, when we're 20% down in a matter of weeks, just like we saw during COVID, just like we saw during the fall of 2018, the risk reward starts to shift towards, DCAing into positions that have gotten very cheap, that are oversold, especially in sectors like, AI theme sectors where the demand is still very high. But as we get back up towards the levels that we're at today, or even a little bit higher, that risk reward balance starts to shift again. So now it starts to be, okay, do I really want to buy a lot of incremental exposure at these prices, knowing we still haven't resolved some of these uncertainties, knowing that there's still elevated risk of recession, et cetera. So I feel pretty good about having 41% cash in the portfolio. Would I like to have maybe a little less and have bought a little bit more, knowing what we know now? Sure. But, you have to play the game with the info you have at the time. All right, y'all. Hopefully we got some good info out there today. I shared this spreadsheet. I can post the link in the description later as well. If you've got any follow-ups, let me know in the comments. Got a lot more content coming here. And I'll see y'all soon. Thanks for joining. Cheers.